Lots of new rules that have been suggested when it comes to the banking space. The RBI panel records proposed changes to ownership guidelines as well as to corporate structure for banks. We've got Tamal Bandyopadhyay joining us on this and Sandeep Parekh, our expert panel, to sort of decode this for us. Gentlemen, thanks for being with us. Tamal, if I can come to you first, a couple of questions. In terms of really the thinking behind this, what do you feel were the major motives for the RBI suggesting that NBFCs, or the larger NBFCs in this case, can be given an opportunity to receive that banking license? And what is the kind of impact you see this making on ground? How soon do you feel some of these suggested recommendations could actually be implemented?
Well, let me take the last part of your question first. How soon? As you all know, it's an internal working group, 2 members from the RBI board and the rest from Reserve Bank of India senior executives, executive director and CGM, etc. So it is not an official RBI document. So let's make it very clear. It's just there have been discussions, and there have been I would say, asymmetry and inconsistencies in RBI's approach to licensing over a period of time. So iron out all this committee has been set up. And there's an internal committee, internal group, which does not necessarily mean that each and every recommendation will be accepted. We need to wait and watch. That's point number 1. So how soon? I don't think it's very soon. Market is jubilant, celebrating. Yes, let it celebrate, but we need to wait. Second is NBFC, larger NBFC you spoke about with 50,000 crore asset book and 10-year track record. Now, in some sense, allowing larger NBFC and allowing corporations into banking, in some sense, they are interlinked, because some of the larger NBFCs are run by corporations, not all by them. And if you look at this corporation's entry, historically, RBI is a divided house. Like, for instance, Rajan was against it, and Subbarao was sort of in favor of it. In fact, 2013, the licensing norm did not bar Indian corporations to enter into, to look for bank licensings. It's another matter, nobody could get it. We can discuss it later why. And there are a couple of cases where they applied and then they withdraw. Why is this? We'll come to that later if you have time. And then subsequently, the small finance bank licensing norm which has come up, it's prohibited corporations. And now this committee is in favor of allowing corporations into banking. But there are 2 big caveats there. It's interlinked. One is this Banking Regulation Act needs to be amended, which will give Reserve Bank of India take a look at all the connected lending and the larger view of the entire family of the corporate house. Right now, under one segment of the Banking Regulation Act, it's only the common directors, their companies cannot have any exposure. But there is the entire ambit of entire corporations not been covered. So that is a caveat. It has to be done. And second is, it's actually a little vague who will judge it. It says that RBI needs to have a very strong supervision. RBI should be. So it all depends on how confident RBI is. I mean, who will judge that? RBI, as of now, you have seen that even the individuals have failed the fit and proper test. The Yes Bank and Global Trust is the cases. Now, how would is RBI confident enough on what are the props it need to have, what are the weapons it needs to have in its armory to be absolutely confident that to manage this large corporations? Because many believe that Indian banking crisis, the big contributing factor is large corporations. They are over leveraged and there's crony capitalism. They are not bringing their own equity on the table. They are using bank money for equity as well. So it's a class you really need to have your confidence to supervise them. So to cut a long story short, it is interlinked. It says corporations will be allowed, and provided Banking Regulation Act need to be amended to check all the connected lendings, and RBI should be confident about its capability to supervision. So I don't think it is coming. If you are expecting it having it too soon, no, it is not. I end here. We can take it forward later. Thank you.
Fair enough. Fair enough, and we'll come back to some of those points, Tamal. Sandeep, let me bring you in as well. In terms of the viability of some of these NBFCs rushing for that license, the kind of action you see on ground, assuming, of course, this even comes into play anytime soon, as Tamal pointed out, what do you feel is going to be the landscape post these amendments?
So let me answer a different question first, continuing with Tamal's theme. I think the broad issue here is financial inclusion. And if you see, pre-Jandan period, we are one of the worst, banked countries in the whole world. Even now, there's a very long distance to go before, people invest in even in regular bank accounts. Forget more sophisticated products like equities, etc. So I think it's very important that we decide how inclusive and how large we want the banking system, which is right now quite small. And it's like a highway. You can set the speed limit at 20 kilometers per hour and dramatically reduce accidents, but people take 3 days to reach from A city to B city as opposed to 10 hours. So really we really need to have more banks, and I think that's both RBI's decision, also a political decision. Will it get a bit more risky? Surely it does get more risky, because then you have issues with respect to related party transactions, lending to related party, etc., etc. So this is going to be a lot more intrusive set of regulations. RBI will have to be much more alert if they want corporates to get into this sector. And finally, I think corporates themselves, I think they will have to really change a lot of their structuring. So it's still some time away before either RBI or the corporate segment which has an existing NBFCs or which want to set up greenfield projects are able to set up a new bank. So we're still a couple of years away from this realization happening, even assuming that this report is implemented fully immediately.
We understand that government is very keen to sell majority stake in the smaller PSUs, Bank of Maharashtra, Central Bank, UCO Bank. So is this perhaps a preemptive indication from RBI that these banks can perhaps be given to corporates?
Possibly, because it's come within a few days of each other, the announcement, though it's still a kind of a rumor rather than confirmed news. But it again plays back into the point which I made is, public sector banks, especially the smaller ones tend to be highly inefficient. So the government really wants to, extract more bang out of the buck, so to speak. And, therefore they're looking at privatization. And, for all its problems, private sector banks have been much more dynamic, very growth oriented. So, the government is applying pressure from making more drops out of the same lemon. They're trying to squeeze out more juice. At the same time, RBI wants to have more banks and probably more branches to reach out. And remember, banks have a huge priority sector obligation. So even if you have a few more bank branches, some of them will seep down into the poorest parts of India. So that there is additional hope there.
Let's talk about the holding structure norms, and on the shareholding pattern on the holding structure norms, a lot of back and forth is there. First, RBI insisted that banks or promoters have to bring their holding down. So we know what Mr. Kotak and others have done to their ownership. Then there was a whole issue of banks, whether they should be held by the holding company or not. Now looks like there is a change of heart or change of view there as well.
Yeah, so I'm sure Tamal has better perspective on this. He has encyclopedic knowledge of the banking segment. But let me just give my quick thoughts. I think, we should have, for the next 50 years, we should have one policy. And I think empirical evidence is very clear, in that it's very unclear, that there is almost no correlation between high or low ownership of banks and bust-ups and frauds. So, we've seen so many evidences of very high ownership where huge problems have occurred, and also very, very low ownership where frauds have occurred. So I don't even see this as really a big issue for RBI to regulate. And secondly, if they do something, I think they should keep it steady for the next 50 years. You know, we can keep arguing about whether it should be 16 or 16 and a half or 17 or 26 for eternity. But I think the idea should be, it should be one number, whatever in the collective wisdom of RBI, and they should stick to it for the next 40 or 50 years.
Tamalda, this is where I'll encourage you to come in on the whole promoter holding in banks. A lot of back and forth is happening, even on the holding company structure. A lot of back and forth is happening. Few quarters ago, Ujjivan, Equitas, all of them have followed a different structure model. Now the RBI indication is completely different. So isn't there a give and take happening there?
No, absolutely, Nikunj. I think it's a very valid question, and there has been, as in my preliminary remarks, I said there has been inconsistencies in the RBI's approach to things at different times. I do not want to get into historic because Sandeep says I'm encyclopedia. I don't want to reel out the dates and years, etc. But there has been, and now there are three things important here. One is this: the promoters holding now it's saying it can be at 26%. Right now, this is in sync with the voting rights. If you have seen that voting rights, which was earlier capped at 10%, Banking Regulation Act was amended, and which empowers RBI through regulations. It can be raised. So it has been raised from 10% to 15% to 26%. So when you have capped the voting rights at 26%, you have no business to cap the promoters holding at a much lower level. So I think that has been anomaly, which is being corrected by lifting promoters holding to 26%. So this is now in sync with the overall thing. The inconsistencies have been ironed out. So it's not as sensational or as sort of something very important and epoch-making thing that corporate entry. It is an incremental development. It should have been done much earlier. It is being done. That's point number one. Point number two is, which is very interesting. If you have seen that, it is for all the existing, all the till now, all the licensing norm has given the roadmap for how the promoter would bring it down. But this paper, it says no, it's left it to the promoter. Promoter itself will give it. So it's in 15 years, you will bring it down. Now, whether you will give it one shot, whether in 3 stages, 4 stages, RBI not imposing its thing, it says the promoter will leave it. So I'm not very sure. I mean, how will you implement it? And it's very progressive move. You are trusting the promoters. You are saying that you decide how to do it. But there will be a COVID situation. There will be some other kind of situation. Like the promoter says, sorry, I was planning to do this. I will not be able to do it. So what do you do? What do you do it? RBI is following a hands-off approach, is leaving everything to the promoter. So we need to see how it evolves. And final thing is, which is an extremely critical part, it has been back and forth, is a non-operative holding company. Now, if you see that the Subbarao regime, the 2 banking licenses were given, there are many corporations applying for it. I think it is roughly about 26, 28 odd. 2 of them got, none of them was a corporation, which is one Bandhan Bank, MFI turning into a universal bank, and second is IDFC, which is a infrastructure financing company turning into a bank. None of them got into. One of the reasons the corporations, also a few of them withdrawn from this, was this structure of non-operating holding company. And after that, when the small finance banks licensing came, RBI had done away with that. And now this particular report, it brings back it again. It says that we should get into the non-operating holding company structure. What does it mean? It says that if you are in other businesses as well, you need to have this NOFC structure. And if you don't have any other subsidiary, any other businesses, you can straight away hold a bank. This is a very, very, I would say, a very important clog in the wheel. This would discourage many of the corporations, because this and combination of the Banking Regulation Act will actually expose the entire corporate structure to Reserve Bank of India's inspectors and supervision, they would ask you anything and everything. Now, corporations might not be able to, will not be able to. I mean, none of or many of them would not be comfortable with this. Now, should it be done or shouldn't it be done? That's a separate story. So, along with the corporate entry, RBI has done two straight caveats. That's RBI's ability to supervise should be improved, and Banking Regulation Act should be amended to give RBI unfettered power to check connected lending, etc., which is not there. And more importantly, this structure, which you are hinting at, and again, it's a back and forth structure. Super House regime, a non-operating holding company. After that, Raghuram Rajan's regime, it is done away with. And the company, this particular report says we should bring this non-operating holding company structure. And I think it is being used as a safety valve. If the corporations allowed and get into banking, this will be a safety valve, because this will give a 360-degree view to the RBI inspection team and supervision team, to the entire corporate structure, which many of the corporations may not like.
Speaking with you, Tamal, Sandeep, good to have you share your knowledge on this matter and how you see things evolving in the industry. Do have a good day. Thanks for joining us.
Thank you. Thank you.